Then I want you to take a look at this about sentiment toward the economy and how a certain Fed, well, big official feels about things. Take a look.
Right now, I think this view that my colleagues have expressed in our various projections that 3 rate hikes overall for this year seems to be about right. I think there's some upside risk to the economy, not risk, but upside potential to the economy. Maybe we'll need to have maybe 4 rate hikes this year, depending on the economic data.
All right, John Williams saying maybe 4 rate hikes. I don't know whether he was basing that on the possibility the tax cuts go through, but again, he intimated as much as he could as a Federal Reserve official to Maria Bartiromo that would in fact be more likely than less likely, more hikes than fewer hikes. Let's ask the St. Louis Fed President, James Bullard. James, sir, good to have you.
Great to be here.
When you guys base a move on rates, what's the first thing you look at?
Well, we look at the most recent economic data, and we have forecasts. A big staff, very technical staff, and they prepare a lot of information, look at global developments and so on.
But it's things as they are now.
And projected to be going forward.
All right, so projected going forward, if you're the White House, tell it will be big tax relief. Democrats aren't so convinced that happens. How do you play that in? Because tax relief could be a huge economic stimulus.
Sure, and it could be very important. But the way I've been thinking about it is that, let's take as a baseline, for purposes of monetary policy, let's take as a baseline that we're growing at 2%. And unemployment's fine and inflation is fine. There's really nothing that needs to be done here right now. And then we can wait and see how this political process plays out. Maybe it'll go great and you'll get a lot of growth out of it. Maybe it won't. But we don't really need to bet ahead of time on that. We don't need to be preemptive in this situation, in my view.
Okay, so going on things as they are now, are you in the camp that says rates continue going up, maybe 3 more this year?
No, we've got the flattest rate path of anybody on the committee. We're flat for this year. And
flat being no moves.
No moves.
Why?
So, again, I think let's play. Well, growth is 2% in 2015, 2% in 2016. First quarter tracking is below 1%. So we don't really have a lot to go on.
First quarter tracking right now is below 1.
Yeah. Inflation has just come up to 2% with the report today, and unemployment hasn't really changed for the last 15 months. So a lot of variables are very stable going into this. There's obviously a lot going on in Washington. I understand that. But from the hard data just looks very smooth right now. So let's wait and see what happens. Let's see how it plays out. And then if the growth starts to pick up a lot, if inflation starts to pick up, then we can start moving. I don't really think we have to get out in front of that process.
All right. Do you pay attention to the markets and their enormous run-up since Trump's election? And obviously that's stimulative.
There's a wealth effect out of that. I think the main thing that's gone on with the equity markets is the perspective of corporate tax reform in the future, and possibly personal tax reform, capital gains taxes. By itself, that would be enough to revalue the U.S. corporate sector on the order of 10 to 15%, which is roughly what we've seen during the election. If that falls apart in Washington, I'd expect some of that, or maybe most of that, to come back out. There's also been better corporate profits. That's also been feeding into this, so that's an important factor as well. But I think that the run-up is not necessarily due to the idea that Wall Street thinks there's more growth out there in the future. There might be more growth out there in the future, but all they need is the tax rates to change to revalue the level of the stock market. So that would be a one-time move up,
right?
And then it would go from there, depending on what happened.
Obviously, we have this huge debt. It's not going away anytime soon. It's at almost $20 trillion. We could be facing a spending crisis in a month and a debt ceiling quagmire. How much does that enter the equation for you?
Well, it's up to the Treasury to manage the debt, and it's up to we have congressionally mandated
but
goals.
The cost of that debt, carrying it, has been very low, right? With historically low rates, just a slight uptick makes it a lot pricier.
Yeah. So we need to do what we need to do to keep inflation near target and to keep labor markets humming.
But does that enter the equation for you, James? That will you look at that and say, you know, if we move too aggressively here, we could shoot ourselves in the foot?
Now, I mean, Congress has to come up with its budget given the interest rate environment. Treasury has to manage the debt load given the interest rate environment.
They've both done a horrible job.
Our policy is, we're handed these by law, these mandates, and so we're supposed to hit our mandates. And by the way, we're doing a great job. Inflation rate at 2%, unemployment below 5%. Interest rates are moderate. So
do you ever wince at the criticism that candidate Trump had of the Federal Reserve, not going so far as to say, do we even need a Federal Reserve, but critical of the chairman, and a little less so, obviously, the presidency could change you, but how aware or how much noise does that make in a room when you guys gather?
I like to listen to everybody in the monetary policy debate, all sides. The St. Louis Fed has been kind of a renegade bank over the years, so we've listened to a lot of the critics and brought the best, tried to bring the best ideas on board.
Do they talk to you because you seem out of sync with them?
Who?
The other members.
I talk with them every day. I've known most of them for 20 years.
But so. I guess when I'm kidding to make the point that when you are at odds with the crowd that says 3, 4 more hikes, how does that go down when you just say, wait a minute?
I like to think they listen very carefully to what I say, but maybe I'm kidding myself.
But maybe they don't see the slowdown or the stymied environment that you do.
I don't see the growth.
Environment.
I don't see the growth that they want to point to. I don't see it. Not right now. Maybe prospectively, but like I say, I don't think we have to get out in front ahead of time and be raising rates ahead of time. Because we think there might be growth ahead. You could just wait and see if that develops.
But you don't see your role as being responding to something that could be coming down the pipe.
Not in this situation. I mean, if inflation was up at 3% and was threatening to go higher, you know, I'd be all over that. And I'd be saying, you know, we got to get that under control. And plus, you got this thing going on in Washington. That's not really where we're at. The, you know, inflation rate is just, core inflation is still below 2% even today. So, you know, we're not in a situation where we have to be preemptive. If we were, I would be preemptive, but I don't feel like we're in that situation today.
All right, real quickly, the president, 2 executive orders, you know, trying to clamp down on trade and those with whom we trade and whether they've rigged the system against us and hurt us. China, a big target of that. How does the Federal Reserve weigh in on that sort of thing?
Yeah, trade's an important issue, but it does take a long time to reorient trade policy because trade negotiations take a very long time. You can do one-off things, but then the other countries can as well. And so I think it's a long game issue. It does affect the economy, but it's a long game issue. A lot of what we talk about in monetary policy is short game, 18 months, 1 year. We're trying to adjust rates in that kind of time frame, and I think trade is more like 5-year issue.
All right, finally, when some of your colleagues, so many of your colleagues are saying at least 3 more hikes this year, and I know you don't share that view. What do you think would happen if we did get 3 more hikes this year?
I think it'd be a bit of overkill. You might see longer-term rates come down, which is what we've seen since the March move. You might see inflation expectations fall. You might see a little bit slower growth, I don't know. So you might see a little bit of dampening on the economy more than you expected. I think we could do something else, though. We could allow the reinvestment policy to end, and we could allow the balance sheet to start to normalize. That's what we should be doing.
Your balance sheet is what?
$4.5 trillion. It started out at $800 billion before the crisis. $4.5 trillion today, so it's very large. I think in a relatively benign environment, now is a good time to let it come down.
All right, a real pleasure talking to you, James Bullard. He's the St. Louis Fed president, very collegial on this board, where he kind of stands out, but we'll see. All right. Didn't say a bad word about anyone, and I tried my best.